We are going to exclude or subtract raw material consumption. That is not going to be a part of it. We are going to talk about the secondary sector and the tertiary sector altogether. Concept of this value added, why people talk about this value added methodology so much. As this method focuses on net value addition by each and every component in production. Good morning and welcome to the fifth session in Business Decision Theories in Unit 2, where we are going to speak about the value added method. Probably this is one method which is very, very interesting. We have spoken about it in the three types of calculation factors in GDP, but then value added method, when we start looking at in detail, it's a very, very exciting and an important method to calculate. Now, this is one of the standards that is followed by our country in terms of determining the national income. The other two methods are expenditure and product method, which we have already seen in the previous sessions. Now, this is also known as the product method or output method, and its primary objective is to calculate national income by taking the value added to product during different stages of production into account. So value added, what do you mean by the word value added? That means step by step. That is, whatever stages we have gone down, then only you will be able to add value back. That's how we have to start seeing in terms of the production. Now, every product that we manufacture in our country has got some value. One is the physical value, that's the book value that we are talking about. Plus, the product undergoes a lot of transformation in terms of the value addition. So the product is not just going to be launched in the market saying that this is one final price, because people are going to come back and ask you this question: how is the value of the product derived? So what happens here is that every stage of production, there is some value that is being added to that product. And that product is very, very important for all of us. Why? Because that product will be able to tell us exactly what is taken into account, what are all the different factors that we have added upon. Now, to determine the national income using this method, the first step involves calculating the net value added at factor cost. Now, you don't have to worry that we are going to do some mathematical problems here. This is just a theory which you need to understand and appreciate. So the first thing that we are going to do is that we are going to look for the net value added. So this is what we are going to look into it: net value added at factor cost. So calculating the net value added at factor cost requires net indirect taxes to be deducted. So the net indirect taxes to be deducted. So from here, we would subtract the net indirect taxes. I would write it down as NID, net indirect taxes, to be subtracted altogether. This method of calculating the national income arranges the economy at different categories of industry, such as transportation, or when we talk about fishing, agriculture, communication, and so many other sectors. Now, why are we interested about this method of calculation? So we already have an expenditure method, we already have an income method. So why are we so bothered about the factor called as the value added method? Now, when you look into the industries like transportation, agriculture, communication, or the sea exports, the seafoods altogether, there is a lot of value addition that keeps happening at stage by stage. This is not a one-time cost, a one-time realizable value, because there's so many factors that are involved in that. Let us start with the transportation itself. Now, in transportation business, it is not just about that physical lorry or the truck that we are going to talk about. Once the goods are loaded, the value changes. Once the goods are delivered, there is a different value. The loading, unloading, packing, delivering, there are different stages altogether. In each and every stage, you need to understand the value that gets added upon is entirely different. So that is very, very important for all of us. Without that, we will not be able to arrive at a final destination or at a value. The second thing is that when you look into agriculture, communication and all those factors, these are all stage by stage enhanced value. These are not something where you will be able to decide the value in one go or in one shot. You will not be able to come and tell me that yes, this is done, this is completed. Why? Because if you look into agriculture, the sowing of seeds is one particular time. Then you start seeing that the plants are growing. Then there is a harvesting season. From the harvest, then you go in terms of packaging. From the packaging, it goes to the market, that is the sales. So there's a step-by-step process involved. In each and every step, the value of the product will change. So that is where the value added method becomes an important factor for us in terms of calculating the national income. The national income is not going to be that easy. It is involving the stages of production. So that's where you have to be very, very clear about it. Now, let me talk about the communication sector also. In this, if you start seeing, though we have many service providers, when you talk about an Airtel or a Jio in the market, it is not that easy. Why? Because starting up is one stage in communication, adding up the users, then providing services, then value added services. You would have heard about this word called as VAS. In your mobile, value added services. Now that's exactly where we are coming back to this scenario. Why? Because when you start adding up packages in terms of streaming the services, automatically the value, the income starts going up. So that's why these are all segments, these are all the areas where you will see that the value added method really increases or creates an impact towards the national income accounting. Followed by the components. What are the components that we are going to talk about? As this method focuses on net value addition by each and every component in production, hence the following elements should be excluded or subtracted. So we are going to exclude or subtract raw material consumption. That is not going to be a part of it. Capital consumption and the net indirect tax, which we had subtracted in the previous slides. So what we are going to do here is that first we are going to try to understand what is that we are seriously looking into. The one thing that we are seriously looking here is that this is going to talk about the net value addition by each and every component. So there's a net value production. So that's how we are going to look into it. So what is it all about? The raw material consumption. We are not going to look into it. Why raw material consumption is not included? Why? Because that's a capital factor. It's already money which is invested. You have bought the raw materials. The investment has already been done. So we are not going to look into the raw material consumption. It is a sunk cost according to us, which has already been bought into picture. Capital consumption. So when you want to start a business, you are going to invest some money in the form of capital. So that we call it as the investment cycle altogether. So investment is already done here. The capital factor is already taken into consideration. So again, we are not going to talk about capital. The next thing is the indirect taxes. The net indirect taxes are one which needs to be subtracted as we have seen previously. So in that case, the net indirect tax is something which is going to be not directly charged upon, it is going to be given off. So we are not worried about the net indirect tax also. So these are certain things which has to be excluded away from the factors of value added components. Then only you will be able to arrive at the net value addition, followed by steps to compute national income. So what are the steps that we have to involve in terms of computing the national income? Identification and classification of production units. So that's the producing units. So what we tend to do, we identify all the producing units of the domestic economy, classify them into primary, secondary and tertiary sector. A very, very important factor that in economics that you have to learn it. What is the primary sector? what's a secondary sector, and what is a tertiary sector. Now, primarily, we have identified manufacturing, agriculture as one of the primary sectors. Then we start getting into the services sector. We start the IT enabled, then we go to mining, metallurgy, then we go to transportation, where we go to all kind of allied services, which classifies them into the primary, secondary, and tertiary. So primary sector, according to us, means that they are the core components in terms of providing revenue, which means agriculture and manufacturing are the core sector for any economy to pick up. Moment the manufacturing sector picks up, we have a index called as the PMI index, Purchasing Managers Index, which is a very, very important factor that measures the value of the manufacturing. That's the output that is basically which is being calculated there. The PMI index will tell how is the manufacturing sector going up, and that's a core indication for a revival of an economy. So definitely that is going to matter a lot in terms of the business. This is definitely one of the big indicators that we are talking about. Followed by, we are going to talk about the secondary sector and the tertiary sector altogether. Secondary sector is something which is closely related, and they would try to provide some services, the allied services. Like when I talk about the IT and IT enabled, they are secondary. Why? Because that is not the core source of income. Of course, there are a lot of money that is going to spin out in terms of services sector that's coming inside, but that's not the primary occupation on which we are classifying. So secondary sector is also important, followed by the tertiary sector, which is allied services, value-added services that are being provided to the economy. Now, with all this, let us move to the estimation of gross value added to the each sector. Now, how do you calculate it? GVA, the gross value added, is equal to value of the output minus intermediate consumption. Now, the value of the output, what is the value that is generated by the company, by the individuals when it is being spoken about? So, the value of the output matters a lot, because value of the output will tell what is the final value that's coming out minus intermediate consumption. So in between, in the meanwhile, if there are going to be some consumption, some takeaways from that particular part, so we are going to say the gross value added is going to be a functionality of value of the output minus intermediate consumption. Step 3, estimation of GDP, or the factors when we are going to calculate. Add GVA of all three sectors, primary, secondary, and the tertiary sectors. Please add it up. Then you will get the GDP of the economy. So the gross value added up of the primary sector, the secondary sector, and the tertiary sector put together will give you the GDP of the economy. So that's what we are trying to understand in terms of the national income. Now, the next one is the step 4 of estimation, finally, to come from determining the national income from the net national product factor cost to the GDP at the market price. Net factor income from abroad is added, NFIA, net factor income from abroad. Why? Because the money that is being sent in by the residents of India from abroad to the market, that is to the Indian country, is definitely going to be added upon. That's a very, very important function. Depreciation, the usage value has to be subtracted. Many times what happens is that people ask this question, they say that, sir, how this has to be deleted? Why it has to be deleted? It has to be subtracted because this factor, depreciation, is something like the wear and tear factor. So this has to be subtracted from the whole system. So this cannot be taken into account at all. And the net indirect taxes also needs to be deducted. So depreciation factor and the net indirect taxes have to be deleted altogether. When you do this deletion, you will be able to arrive at the income factor formula. So how do we calculate it? The net national product at factor cost, very important, is equal to GDP at market price minus depreciation, first thing, plus net factor income from abroad minus indirect indirect taxes plus subsidies, when you add all this factor together, you will be able to get your net national product at factor cost. Just look into the formula very clearly. Why? Because that will tell you what is the importance here very clearly. GDP at market price. So we are taking the actual factor here. We are not going to take any base here. It's like a nominal GDP here. Minus depreciation, remove all the wear and tear factors. Those things will not be a part of the system. Followed by the net factor income from abroad. The net factor income, that is the money that is coming in from our citizens residing in abroad. They are going to give the money back to our country. So that is also going to be counted inside. Very, very important. Minus the indirect taxes. The indirect taxes has to be removed, followed by the subsidies factor. All the subsidies have to be added back into the system. Now, the concept of value added, which is very, very important for all of us to understand here and proceed. What is the concept of this value added? Why people talk about this value added methodology so much? It refers to the addition of value to the raw material, which is their intermediate goods by the firm and by the virtue of its productive activities. What is the virtue of its productive activities? Why are we so concerned about it? The value added refers to the addition of value of raw materials, because intermediaries come into picture for a firm. As I was talking about an automobile sector, or even let's talk about the manufacturing of watches by Titan. When you are just going to talk about a watch, it is only a mere timepiece. But that's not what Titan wants to project onto its customers. Titan wants to say to its customer that it is not just a watch, but it is a value addition to your lifestyle. They don't just sell a watch. They don't just sell a timepiece. They sell a brand. They sell an entity to you. They sell some value to you. So how do they do that value addition? They change the modulation. They bring in a modulation here into the watch. They add certain factors. It might be the gems, it might be the stones, it might be the design, it might be the intellectual factors that they are going to put into it, which makes that watch become more valuable in nature. So the final value of the product is again going to depend on the intermediate products that are going to be added there. When you just talk about a car consists of 4 wheels, a steering wheel and some engine. But then you are not just looking for a car with 4 wheels and a steering wheel. You are looking for some value addition in the car for the amount of money that you're going to invest. Which means for the industry, there needs to be a value addition that has to be given. Whether that might be a technology pack that they are talking about, or that might be an exterior or interior, or some other kind of addition which is going to derive value for the customer as well as for the manufacturer. So definitely the concept of value added becomes very, very important, and that is a part of the production activity. So that's why I say virtue of its productive activity altogether, and followed by it the contribution of an enterprise to the current flow of goods. Contribution, please look into this word very carefully. The addition, what do the enterprise do to the flow of goods and services? It's calculated as a difference between value of goods and the value of intermediate consumption. So the real value added meaning comes here. Value of the output minus the intermediate, minus all those factors. What is the final addition that is put on to the table? That is highly important for all of us. So we are not going to go back and say that the addition factor is done just like that. The addition factor comes to us with the thought that there is some value addition which is being done at some level, at some positions altogether. So you have to subtract all those intermediate things to arrive at the true value of the goods, followed by. Now let's look into the example here, consumption example of the concept of value added. Suppose a baker needs only flour to produce bread, which he purchases flour as an input worth 500 rupees from a miller, and then by the virtue of its productive activity, he converts the flour into bread and sells it for 700. So he bought flour or wheat at whatever price, at 500 rupees. But then when he converts that wheat or flour into bread, he's going to sell it at 700 rupees. So the difference now is 200 rupees that we are going to talk about. Now, the flour or the wheat becomes the input. That's an intermediate good according to us. Why? Because it is going to get converted into a meaningful product. So that value is only an intermediate value, which is termed or which is priced at 500 rupees here. So we say it as an intermediate consumption. Now what is going to happen is that that flour is going to get converted to bread, and now when you're going to subtract the value, that is 700 minus 500 here, you are going to get the value as 200. So that is the true value added. At the end of the day, when that baker is going to sell the bread in the market, the realizable value, the value added is only 200 rupees. That is what you need to see here. So value added methodology matters a lot. Why? Because we are talking about the conversion of goods into something productive, into something valuable altogether, which you and me would not be able to see it through our naked eyes. But then over a period of time, when you understand the flow, when you understand the production activity that goes on, you will be able to appreciate the output. Now, the next thing is that the difference between the value of output and immediate consumption, as we were talking about, is the value of that 200 to the total flow of the final goods. That is what we are looking in terms of the service value. Now, value added by each producing enterprise is also known as gross value added at market price. Let's understand this. GVA-MP, that is gross value added at market price. It means the value added by baker 200 rupees is directly that term that either at the value added or the GVA at MP. So GDFP, that is gross domestic product, what we are talking about at the market price is equal to GDP at market price. This is very, very important. At the end of the day, we are going to understand the gross value added is going to come and equate it to the gross domestic product at market price. Now, the next thing that we are going to learn is that the gross domestic product at market price is also equal to this factor, which includes, or let's try to understand, the intermediate consumption and value of output in detail. Now, how do we do this? We use of the intermediate goods in production is termed as the intermediate consumption. So you're using the products for manufacturing something, so we call it as an intermediate consumption. And the expenditure on them is called as the intermediate consumption expenditure. So let's underline that factor also. In the given example, flour is an intermediate good for the baker. So what we are trying to do, he is going to put some expenses on the flour, which is considered to be an intermediate good because he is making an expenditure on that. It's considered to be an intermediate consumption expenditure. Now, for example, flour being an intermediate good, it is merged. The value is merged in the value of bread. So, however, any machinery purchased for making that bread is not an intermediate good. Why? Because that is not we are looking as an intermediate factor. That's a separate standalone factor, capital investment. The value will not be included in the value of intermediate consumption because machinery is not going to be consumed. Machinery is only utilized in making that bread. What is the value consumed here is that the flour is consumed and it's going to be converted into bread, which is going to be looked back in terms of the factor. So what we are looking, the conversion of one intermediate good to that final good. Now, imports are not separately included. Imports will not be included. Why? Because they are already included in the intermediate consumption because it's already taken into consideration. We are not going to have a separate inclusion factor there at any given point of time. That is not going to be counted at any given instances for us because we have already taken it into picture, we have already calculated it into picture. What we are trying to do here is that the value of intermediate goods is already taken into our mind. It is already done, it is already taken as in a factor of consumption. However, if domestic purchases are specifically mentioned, then the imports will be included. Only in the case of a specific mention that yes, it has to be taken, then we bring it into picture. Now, how to measure the value of the output? The value of the output is nothing but the sales altogether. That's what we typically look from the accounting perspective. So when the entire output is not sold in an accounting year, then that unsold stock is added to the value of the sales, which means unsold stock is excess of the closing stock over the opening stock, which is called as the change in stock. So let me just make it understand. If there are 100 units which are manufactured, if all the 100 units are being sold, then we don't have to worry. That's the value of the stock. Out of the 100, only 80 are sold, 20 is remaining. That 20 has to go back in terms to the next year. It's a carry forward. So the change in that excess stock that's coming into picture. So how do we calculate it? The value of the output is equal to sales plus change in stock, where change in stock is equal to closing stock minus opening stock. So this formula comes again into picture. So the change in stock is calculated how? Closing stock minus the opening stock, which will be taken into account. Now, one more way to calculate the value added. The one more way is that value of the output can also be calculated as quantity into price. So let me put quantity into price here, which is a simple formula. Now, for example, if the manufacturer manufactures 1,000 pairs of shoes, which is 500 rupees each. So 1,000 into 500, the total value that is equal to 5 lakh rupees. This is a very simple calculation which calculates the total amount, the total pairs of shoes that which is being manufactured into the value that is being told, and we will get the final value there. Exports are not separately included. Why? Because like the imports, the exports are not separately included because it's already there in the value that is being taken. Only in case of an open economy, sales include both the domestic exports and imports factor, or else it is already included as a part of the system. With this, I come to the end of this particular session. I hope and believe that all the information shared through this session will be of a great help and resource to you. In the upcoming sessions, I would be talking more about the limitations of the national income accounting. But until then, stay tuned, stay blessed, and stay enlightened forever. Thank you once again for joining me today on this wonderful session.